Did you know that over 90% of all cryptocurrency projects launched since 2017 have either failed, been abandoned, or were outright scams? This isn't just a sobering statistic, it's a stark reminder of the immense risk and the critical need for a disciplined evaluation process in the volatile crypto market. Most investors jump in based on hype, leading to predictable losses. By the end of this video, you won't be one of them. You'll possess a robust, 5-pillar framework to dissect any cryptocurrency, separating the revolutionary from the ruinous, and making genuinely informed investment decisions based on fundamentals, not just fleeting trends. The first pillar in our evaluation framework is the whitepaper and vision. A project's whitepaper is its foundational blueprint, detailing the problem it aims to solve, its proposed technical solution, the underlying economic model, and its roadmap for future development. It's not just a technical document, it's a declaration of intent. For instance, Bitcoin's original whitepaper, published by Satoshi Nakamoto, precisely outlined a peer-to-peer electronic cash system, a clear solution to the double spending problem without relying on central intermediaries. What you're looking for here is clarity, technical depth, and a compelling use case that extends beyond mere speculation. Does the project articulate a real-world problem it's addressing, or is it a solution in search of a problem? A vague whitepaper filled with buzzwords like disrupting everything without specific implementation details is a massive red flag. Conversely, a well-structured document, perhaps like the early Ethereum whitepaper that introduced the concept of smart contracts and decentralized applications, offers a tangible vision that can attract developers and users, giving the project a genuine reason for existence beyond a pump-and-dump scheme. Next, we scrutinize the team and advisors behind the project. Even the most brilliant whitepaper is worthless without a competent team to execute its vision. This pillar is about human capital. Who are these individuals, what are their backgrounds, and do they possess the necessary skills and experience to deliver? Think about the early days of Solana. Its co-founders, Anatoly Yakovenko and Raj Gokul, brought deep technical expertise from Qualcomm and Dropbox respectively, providing a strong foundation for building a high-performance blockchain. You should investigate their professional history, past projects, and relevant industry experience, particularly in software development, cryptography, finance, or business scaling. Transparent teams with public profiles, active LinkedIn presence, and a verifiable track record inspire confidence. Conversely, anonymous teams, or those with little to no relevant experience, introduce significant execution risk. Be wary of projects where the team members are difficult to find or have a history of failed ventures. An engaged and reputable advisory board can also add credibility, providing strategic guidance and industry connections, but always verify their actual involvement and expertise, not just their names on a website. Our third critical pillar is tokenomics and utility. This refers to the economic model of the cryptocurrency, how the token is created, distributed, used, and how its value is intended to accrue within the ecosystem. Is there a fixed supply, like Bitcoin's 21 million coins, or is it inflationary? How are new tokens minted or burned? Consider Ethereum's EIP 1559 upgrade, which introduced a burning mechanism for a portion of transaction fees, potentially making ETH a deflationary asset over time and strengthening its economic model. Does the token have a clear, intrinsic utility within its network, or is it purely speculative? For example, BNB tokens are used for reduced trading fees on Binance and for participating in Launchpad projects, creating direct demand. Look for mechanisms that encourage holding and active participation, such as staking rewards, governance rights, or payment for services within a decentralized application. Pay close attention to the initial token distribution. Is it heavily concentrated among early investors and the team, or is there a fair distribution that promotes decentralization and prevents potential market manipulation? Projects with a clear vesting schedule for team tokens, preventing an immediate sell-off, demonstrate a commitment to long-term growth. Moving on, the community and ecosystem are vital indicators of a project's health and potential for long-term adoption. A robust, active community signifies genuine interest and a strong network effect, which is crucial for decentralized technologies. How many developers are actively contributing to the project's GitHub repository? How vibrant are their social media channels, forums, and Discord servers? Look for organic engagement, thoughtful discussions, and a willingness to contribute, rather than just hype and price speculation. For example, the sheer volume of decentralized applications and developers building on ecosystems like Polkadot or Arbitrum indicates a thriving, self-sustaining environment. A strong community not only provides security through decentralized validation but also fosters innovation and resilience. It's a collective brain trust that identifies bugs, proposes improvements, and evangelizes the project. Red flags include communities dominated by bots, hostile or toxic discussions, or a general lack of genuine user engagement. Remember, a cryptocurrency is only as strong as the network it supports and the people who believe in its vision and actively participate in its growth. Finally, we delve into the technology and innovation. This pillar assesses the underlying technical architecture and whether it offers a genuine improvement or novel solution compared to existing systems, both within crypto and traditional finance. Does the blockchain solve a specific problem like scalability, security, or interoperability more effectively than its competitors? Take Avalanche's subnet architecture, for instance, which allows for custom, application-specific blockchains, offering a unique scaling solution for enterprises. You need to look beyond superficial claims of faster and cheaper. Demand technical specificity. Has the code been audited by reputable third-party firms like CertiK or Consensus? Are there active GitHub repositories demonstrating ongoing development and progress? Is the technology truly decentralized, or does it rely on centralized points of failure? Be skeptical of projects that make grand promises without transparent technical documentation or a verifiable proof of concept. The goal here is to discern whether the innovation is genuinely groundbreaking and technically sound, or merely a rehash of existing ideas wrapped in new marketing. Ultimately, evaluating any cryptocurrency isn't about chasing the next 100x moonshot based on social media hype or insider tips. It's about discerning genuine innovation from mere speculation, understanding that real, sustainable value stems from solving real-world problems with robust technology, guided by dedicated, capable teams, and supported by a vibrant, engaged community. Your ability to methodically assess these 5 pillars transforms you from a gambler into an informed investor, capable of navigating the crypto market's inherent volatility with greater confidence and strategic foresight. If you found this structured framework valuable for cutting through the noise in the crypto market, then our next video, which delves into advanced on-chain metrics and their predictive power, will be an essential follow-up. Understanding these fundamental principles is your first line of defense, but continuous learning remains your ultimate safeguard in this rapidly evolving financial landscape.